Okay guys, welcome. So first session today in the 10x Your Options Trading series, so 4-part series. And today we're going to be looking at the 5-step blueprint to options trading success. So this is some of the key things that I think you need to be aware of if you want to become a successful trader. Okay, so the 5 steps that we're going to be looking at today are avoiding the 2 biggest mistakes. So these are 2 mistakes that I see beginners making all the time. I get lots of emails about it. So we're going to look at those and just making sure that you're aware of those mistakes and making sure that you don't commit those mistakes yourselves. Step 2, we're going to be looking at using probabilities in your favor. So really fundamental concept with options trading is sort of all about probabilities. So we'll take a little bit of a look at that. Step 3 is having volatility as your edge. So really important to have a good understanding of volatility as an options trader. Options trading is a zero-sum game. So for every trader who wins, there's a trader who loses, okay? So zero-sum, winner, loser, okay? It's not like the stock market where you can buy shares and, you know, the market capitalization increases over time, dividends increases, and you build wealth that way. Options trading really is a trading game, and it's a zero-sum game. So for every winner, there's a loser, and you basically need to be better than 50% of the people out there, okay? And volatility, having an understanding of volatility is one way to get that edge and to know more than some of the other traders out there. So we're going to look at that. Step 4 is study some Greek. So we're going to look at the Greeks. Going to be a little bit of introduction there today, and we're going to go over the Greeks in much more detail as we go along. You know, as I said in the intro, some of the stuff today is going to be probably a little bit of review for some of the guys who've got lots of experience. We've got some guys in here with 10 years experience, 25 years experience. So some of this stuff is going to be review, maybe a little bit fundamental for you guys, but in trying to cater for everybody, you know, we'll start off with some of the basics, and we're going to get into much more detail as we go along over the next couple of sessions. Okay, step 5 is strategy selection. So I'm going to talk about the 6 core strategies that I use in my trading, and we'll do a little bit of an intro into that, and again, go over that in much more detail as we go along. So some of those key strategies, what I look for when I use them, that sort of thing. Okay, so that's the outline for today. Before we get into that, just a little bit on my story. Some of you probably have been following me for quite a while. You know a little bit about me, but for those guys who are kind of new, just want to give you a little bit of background on me and my trading. So I started trading options in 2004. You know, I've always been a finance buff, even from when I was a little kid. I was always into the stock market. And started in options in 2004. You know, thought I knew a lot about this stuff. You know, I was a finance guy, but really looking back on it, I was really naive and didn't really know much at all. And you know, my results were according to that. So started in 2004, so that's, you know, 12, 13 years odd now that I've been trading for. Spent thousands of hours researching, so I'm really passionate about this stuff. I love, you know, researching, reading, writing about this stuff, and teaching, okay? And you might be able to tell some of that from some of the in-depth blog posts that I've written. You know, I reckon I've got well over 10,000 hours in terms of trading, researching, teaching options. So a lot of experience there that I want to share with you guys. So I live, breathe, eat and sleep financial markets. Somebody asked me earlier what I do for fun. I said I trade options. So, you know, I really enjoy this stuff. I'm really passionate about it, and I love teaching it as well. So hopefully that comes across to you guys. I've written 5 books, so just sort of short ebooks. Some of you may have read those. You know, you can pick them up on Amazon. I give them away for free every couple of months, so keep an eye out for that if you don't have them. 3 of them were best sellers. So if I go back to my first trade back in 2004, when I first learned about options, my first trade was a put option on a retail stock, right? And the main reason I entered the trade was because it was cheap. Okay, that was my one deciding factor for entering the trade. The put option only cost me $200, and I figured if I lost it, then it was no big deal. Okay, at the time I owned some stocks and mutual funds, and I figured, you know, if my stocks went down, you know, my put option's probably going to make money because, you know, stocks are going to go down, right? as you can probably guess, I suffered a 100% loss on that first trade. Only $200, so not the end of the world. I've had bigger losses over my time, but it was certainly a learning experience for me. My stocks went down, the stocks that I owned, and the retail stock went up. Okay, so that was a really good first lesson for me. So I ended up losing money on the stocks that I owned and the put option. Okay, so that was my first trade. So a bit of an inglorious start. From there, I started learning about credit spreads, iron condors, and other option strategies, covered calls, things like that, all the stuff you guys are learning about. I was really excited and sucking up as much knowledge as I could from any source I could find. I read countless books, blogs, attended webinars, all that sort of thing, all the stuff you guys are doing. You guys are here today, you want to learn about this stuff. You've got a desire, you've got a passion for it. I had some success, but really I was just a bull market genius, as they say. Mid-2000s markets were going up. It was really, really easy, right? So then the massive bear market hit in late 2007, early 2009. So that was another eye-opener for me as I took some big losses. So I made every mistake in the book in that time, and you guys, maybe some of this rings a bell with you guys. Maybe you've made some of these mistakes. So I'd have a good winning streak, but then I'd give it all back with one bad loss. So I'd be ahead 3-4 months in a row, and all of a sudden one bad loss wipes out all those 3 months of gains. I struggled to know when to enter, adjust, and exit trades. So maybe that's you. You're not comfortable with coming up with defined rules and a trading plan. I chopped and changed from strategy to strategy. So, some of you might read about, different strategies, gamma scalping, trend following, whatever. Loads of different information out there. There's almost information overload at the moment. And it's like a new bright shiny toy. You might say, oh yeah, this strategy sounds amazing. I've got to try it out. And I sort of did that for a while. I was chopping and changing, and that's really not what you want to do. So now I've just got the 6 core strategies that I use, and I really just stick to those. I don't trade all 6 every month. I might just choose 2 or 3 each month, depending on what the market conditions are. I didn't cut losses early enough, so this is a big one that a lot of other people make. I get a lot of emails about this with people who've got positions that are just too far gone. It's almost, by the time they email me, it's almost beyond repair. There's nothing really I can do to help them. So I did that as well. I wasn't cutting my losses early enough, and I wasn't disciplined. I didn't have a written down trading plan at first. It was all sort of in my head, and wasn't following rules. So that's something that's really important as well. So my first aha moment came when I realized that making money in the markets is incredibly easy. Okay, now that might sound funny, but it's true. Making money in the markets is incredibly easy. There's lots of different ways you can do it. Any monkey with a dartboard can make money in the markets. I honestly believe that. What is much more difficult is avoiding big losses. Okay, so this is something that I see happening all the time. And that was the key for me, is just realizing how important it is to avoid those big losses. So everyone's heard the saying, cut losses early and let profits run, but how many of you actually apply that strategy? Okay, so that was a really key turning point for me, as I became ruthless with cutting losing trades. If something wasn't working, I simply closed the trade and moved on. I couldn't allow losing trades to affect me emotionally. Managing losing or difficult trades expends a huge amount of emotional capital. Okay, it means you're going to miss other opportunities because your focus is clouded. If you've got a losing trade that needs adjusting, or you're stressed about when to take the loss, should you close it, should you adjust it, it's taking your focus away, and it's also tying up your capital, and therefore you're missing other opportunities. And it can be stressful as well. Maybe you've experienced that as well. So it's really important to just cut those losses. Trade's not working, cut it. Plenty of other opportunities out there, and you can move on. So I really believe risk management and trading psychology is ultra important when it comes to when trying to become a successful trader. So they're not sexy things, risk management and trading psychology. It's not exciting, but it's so important, right? My second aha moment was realizing that consistency is the key to success. To become a successful trader, you need to have a consistent set of actions. You can't constantly hop from one trading method to the next, okay? And if you're doing that, I've been there as well. I know what it's like. You kind of get excited about this new idea and you want to try it. but you really just need to have a consistent set of trades that you're making and a consistent process in terms of, planning your trades, managing your trades, and reviewing your trades. So you need to have a process in place. That might be reviewing your trades every month or every quarter, seeing what works, what doesn't, reviewing charts every Sunday night, building out this process. So that's really important, consistent process. And we'll talk about that a little bit as we go along. My third aha moment came when I realized how important patience is in the market. So early on, I felt like I always had to be in the markets, always had to be doing something. I had to have an iron condor on every month, no matter what the market conditions were. But that's not really the case. If the markets, aren't conducive to iron condors, I won't trade them. I'll trade something else. So now I actually prefer to be in the markets less and wait for the perfect opportunities. It helps reduce stress as well. If you're not in the market as much, you're not stressing about positions or worried about what's going to happen. Is it going to crash? Blah, blah, blah. There's always going to be opportunities, and if you can be patient and wait for the most high probability setups, it will make a massive difference to your trading. So that's a couple of things, a little bit of history about me, where I've come from, and some of the key things I've learned over the journey. All right, so hopefully that gives you a bit of background on me. And now we're going to get back to the 5 steps that I talked about. So step number 1 is avoiding these 2 common mistakes, all right? I see these all the time, okay? So if you get nothing out of today's session other than making sure you avoid these mistakes, then I'll be happy. So options trading offers much more flexibility than just trading stocks. You can make money if the stock goes up, down, or sideways, okay? Some newbies get sucked into the idea of making a quick buck, and there's a lot of marketing hype out there which doesn't help. Options can provide amazing leverage, especially out of the money options. Who wouldn't want to control 100 shares of a stock for only a few $100s? Yes, buying out of the money options can make significant gains. The problem is you have to be spot on in terms of both the direction and the timing of the stock movement. So as you know, this can be quite hard to do, especially to do it consistently. So trading that way, to make a profit, the stock needs to move in your direction and do it quickly. Time decay is not your friend. So assume you're bullish on Apple when it's trading at $115. You take a look at the 130-day calls and you can see you can buy a 30-day call option for $40. That's it. Seems very cheap for exposure to 100 shares of Apple, right? And yes, it is. So much so, let's assume you go out and you decide to buy 50 of these calls. It costs you a total of $2,000. So 50 calls is going to represent exposure to 5,000 shares of Apple, which is huge. And I've got there, wowza, I'm going to make, if Apple rallies big, I'm going to make a killing. Okay, so that's what you might think, buying these out of the money calls. If Apple hits $135 later in the month, you could be in line for a $25,000 payday. It's absolutely true. If only it were that easy, okay? $25,000 profit on a $2,000 investment is a 1,150% return. So not bad for 30 days, I think you'll agree, right? Now, at first glance, that kind of leverage is amazing, but don't let the big numbers fool you. You need Apple to rally over 17% within 30 days for this to happen, okay? 17% within 30 days. You need the stock to make a 2 standard deviation move in 30 days, not something that happens very often. I'm going to talk about that in a second. So based on probability, there's a roughly 8% chance that this is going to happen. So would you take an 8% chance of making a big gain versus a 92% chance of making a 100% loss? Okay, that's basically what you're doing with that trade. In all likelihood, the options are going to expire worthless and you're going to lose 100% of your investment. Okay, so maybe some of you guys have traded that way, and if you have, great, and you've made success of it, great, but the majority of times trading that way is not going to be successful. In order to profit in buying out of the money options, you need to seriously outwit the market, have insider knowledge, or just get plain lucky. A better approach is to use probability in your favor and be the casino rather than the gambler. Okay, so buying out of the money options, it's basically like gambling, whereas taking the other side of that trade is more like being the casino. And we'll talk a bit more about probability as I've got there in step 2. But first, let's look at the second mistake that I want to talk about, and I touched on this a little bit earlier. So having a written down trading plan is going to put you ahead of 80% of the other traders out there. And I was there myself. In the early days, I didn't have a written down trading plan. It was in my head. You know, I thought that was all I needed, but really you have to have that written down trading plan just to solidify things and really take the emotion out of your game, out of your trading. So unfortunately, most newbies don't have one. It's either in their head, like it was with me when I started, or worse, they just make it up on the fly, okay? And this is a really important point here. So getting into a trade is the easy part. Really, really easy to enter a trade. You know, you look at your stock or your index, you decide, yep, I'm going to put on a Condor, this is how I'm going to do it, done. That is super, super easy. The hard part of trading is knowing when to take profits, when to adjust, and when to exit, okay? That is the hard part. Having a trading plan will help you with that. It'll help set rules that you can follow. Emotions can get on top of you in this game, and when they do, you're toast, okay? The market will eat you up and spit you out. Having a written down trading plan helps take the emotion out of the equation. You'll have a plan and know exactly what you're going to do no matter what the market throws at you. You can also refine and develop your trading plan as you go along. So part of that is keeping good records as well. So keep good records of your trades so you can analyze what works and what doesn't, and you can then adjust your plan accordingly. So you should have an overall plan covering things like exposure levels, position sizing, eligible stocks, maximum number of trades. So that covers your whole portfolio. So that's your portfolio level trading plan. And then you also want to have a trading plan for each specific option strategy you're going to trade. Okay? So let's say you've got the 6 core strategies. You want to have a trading plan for each one. When are you going to get in? When are you going to take losses? When and how are you going to adjust? And that sort of thing. Now you can download a sample Iron Condor trading plan from the address there, optionstradingiq.com/Condor plan. A lot of you have probably already got that, okay? But that's an example of how you could set up a strategy level trading plan. So if you haven't picked that up, make sure you go and do that. Step number 2, so in our 5-step blueprint, avoiding the 2 mistakes was step 1. Step 2 is using probability. So using probabilities in your favor is the best method for options trading success. You should aim to generate consistent income rather than looking for home runs via out-of-the-money options. So that's not the way I trade. It's not the way I teach, okay? You know, if that's the sort of thing you want to do, you're probably in the wrong place, okay? If you're looking for 100% returns in a year, you know, that's not what I'm about. That's not what I'm teaching. In my trading, I aim for 1 to 2% a month. So I'm looking for 12 to 24% a year. That's sort of the range I'm looking for. If you're looking for 50% or 100% returns in a year, you know, this is another question I get all the time. You know, what's a reasonable return expectation for options trading? Can I make 10% a month? Now, if you're expecting to make 10% a month, that's 120% a year. You know, if you're able to make those returns, you know, you should be running your own hedge fund. I'll give you my money if you can make those sort of returns, right? It's just not feasible. It's not realistic. And if you're aiming for those sort of returns and you're trading that way, you know, you have to be taking on a huge amount of risk to get those returns. So if you're aiming for 100% return, you know, you've got to be able to accept the fact that you might have a 50, 60, 70% drawdown, because that's the only way you can get those returns, is by taking on a huge amount of risk. So what I'm looking for here is a consistent process where we're looking for a small return and avoiding those big losses. That's really the key, okay? Typically, the broad markets are going to trade in a sideways manner the majority of the time, okay? Not always, but the majority of the time. It's been said that 80% of options expire worthless, so why would you want to be a buyer of options? So hopefully I'm drilling this into you now. You know, buying options, buying out of the money options, you know, it's a difficult way to trade. I'm not saying it's impossible, but it's a very difficult way to make money, and it's certainly not the process I use. Market makers, and you should know what a market maker is. If you don't, email me, that's fine. Market makers know that buying out of the money options is a fool's game. So they tend to trade from the sell side. And why is that? Well, it's all based on probabilities, but you don't need to be a math geek. So, you've got things like the Black-Scholes model, things like that. You don't have to worry about stuff like that. There's so many programs out there that are just have all this stuff automated now. So you don't need to be a math geek at all. So don't let this sort of scare you off if you're not good with maths. But hopefully you're pretty good with numbers being an options trader. So these days market makers use mathematical models to determine the price of an option. These days it's all computerized, it's all automated. Knowing the likelihood of a stock reaching a certain point allows them to set a price based on probability. I had a really good question this week as well about out of the money options. So someone was asking me, if I go and sell an out of the money option, why would the market maker take the other side of that trade? And the answer is, well, they have to, because they have to create a market. But what they do is they buy that out of the money option and then they offset the risk somewhere else, okay? So market makers are really just facilitating trades and they don't want to have exposure, particularly not to out of the money options. They're typically going to be skewed on the sell side of the market. Okay, hopefully that makes sense. So in terms of probability, what we've got here is a bell curve or the normal distribution. And you can see that within a 1 standard deviation move, prices are going to stay within that range around 68% of the time. And within a 2 standard deviation move, around 95% of the time. So majority of the time, stocks are going to stay within that 2 standard deviation move. Now, financial markets are not precisely normally distributed. So, you might have heard of the term fat tails. So that's the sort of, the flash crash, the 1987 type events where you get these 3-4 standard deviation moves, and those do occur, and we need to be aware of that, and we need to protect ourselves from that, and I'll share strategies with you to do that. But the majority of the time, stocks are going to stay within this range, okay? So this is a probability estimation tool, I guess you might call it. A lot of brokers and platforms out there will have this sort of thing. It's pretty simple. You've got a stock trading, around 115. It tells you a 1 standard deviation move to the downside, it would be 105. 1 standard deviation move to the upside is 122. 2 standard deviation move is 98 and 131. And it tells you the likelihood of the stock staying within that range. Now, it's not perfect. No one can see into the future, but this just gives you an idea, and you might like to use something like this to help you in terms of strike selection and where you're going to place your strikes, okay? So using probability analysis gives traders a very useful tool for determining prices to trade against, and they are free on most platforms, okay? Now you can also use delta as a quick estimate, and I'm going to get into Greeks in a lot of detail, particularly in session number 2, and I'll touch on them briefly today. But delta can be used as a little bit of an estimate of probability. It's not perfect, it's not exact, but it's a good estimate. Okay, so step number 3, volatility is your edge. So this is something that we really want to get our heads around. Again, this is just sort of an introduction. You guys who've traded for a long time, this is going to be pretty basic for you. But everyone else, it's good to have a good fundamental base. So we're going to cover this before we get into it in more detail later. So volatility is an extremely important factor to understand when trading options. Master this and you will be ahead of 90% of other retail investors. Okay, if you can have a better understanding of volatility than all the other retail investors out there, you're going to be ahead of the game. Okay, that's your edge. So there's 2 types of volatility. Historical volatility, which is a measure of how much the underlying asset has been moving in the past, and implied volatility, which is the expectation of future volatility, or the expectation of how much the stock is going to move in the future. For example, if a stock's got an earnings announcement coming up in the next week, implied volatility is going to be quite high because there's a big unknown there. Is the stock going to go up a lot? Is it going to go down a lot? There's a lot of uncertainty. So implied volatility is very high, and that means option premiums are very high because traders are expecting a big move. Just like a stock, you want to sell volatility when it's high and buy volatility when it's low. Okay, so here This is a chart from iVolatility.com, which is a free platform. The blue line is historical volatility, so that's how much the stock has moved in the past, and the sort of yellowy orange line is the level of implied volatility. And one key thing to notice here is that every couple of months you get this big spike in volatility, both sometimes historical and also implied volatility. That's leading up to an earnings announcement. That implied volatility jumps up. You got this big unknown. The earnings announcement comes up and is released, and implied volatility drops down, okay, because the uncertainty has been taken out of the market. So this is something that I look at, religiously whenever I'm going to make a trade. I'm going to look at this chart. Where is implied volatility now compared to where it's been in the past? And when it's low, I want to get long volatility. I want to buy volatility, so I want to be long Vega. That should make sense to you guys, hopefully. If not, don't worry, we're going to cover it in more detail. And when implied volatility is really high, I want to be short volatility. I want to sell volatility. I want to have negative Vega, okay? So here's a theoretical example to demonstrate the idea. So let's take a stock that's priced at 50, and we'll look at a 6-month call option with a strike price of 50. So at the money option, 6 months out. If implied volatility is 90, the option price is $12.50. So volatility is really, really high, the option price is high. Implied volatility at 50, the option price is going to be $7.25. And if implied volatility is 30, the option price is going to be $4.50. So we want to be buying the option when it's at 30, when implied volatility is at 30. We want to be selling the option when implied volatility is at 90. So that's a sort of a basic example of how prices of options might change depending on the different level of volatility. Okay, so we're going to go over volatility in much more detail, but for now let's move on to step number 4, which is studying some Greek. So Greeks are risk measures that can help you choose which options to buy and which to sell. With options trading, you must have an idea of the direction of the underlying, as well as a view of the direction of implied volatility, and then factor in the timing. The Greeks help you tailor your strategy based on your outlook. Understanding the Greeks gives you even more of an edge in this zero-sum game of options trading. So remember, always remember when you're making a trade, it's a zero-sum game. There's going to be, whatever trade you're making, there's going to be a winner and there's going to be a loser. So you need to really understand the Greeks, okay? Very, very important. So the Greeks, a couple of them here. Delta, which is the options sensitivity to changes in the underlying stock price. It measures the expected price change of the option given a $1 change in the underlying. Okay, so if your delta's at 50, the stock goes up $1, your option price is going to change by 50 cents. If your delta is 20 and the stock goes up by $1, your option price is going to change by roughly 20 cents. Okay, so that's delta. So a high delta is a high exposure to price change, a low delta is a low exposure to price change. Vega is the option sensitivity to changes in implied volatility. A rise in implied volatility means a rise in option premiums, and so will increase the value of long calls and long puts. Vega increases with each expiration further out in time. Okay, so you go further out in time, you've got a higher Vega exposure, a higher exposure to volatility because the trade has a longer time period, the stock has a higher chance of making a big move in that time. Okay, so again, Vega, you want to be short Vega when implied volatility is high. You want to be long Vega when implied volatility is low. Theta is the option sensitivity to time, and it is a direct measure of time decay, giving us the dollar decay per day. Theta increases exponentially as you approach expiry. So this is one of the main concepts of how I trade, is you're picking up time decay. You're picking up that decay of the options over time. And what you want to do is, if you're short Vega, you're generally going to be long Theta, okay? So you're going to be making money as time passes. You're kind of selling insurance, I guess, is one way to look at it against a big price move. Now, if you've got a Theta of 100, that means roughly you're going to make $100 per day due to time decay, assuming there's no other change in, the stock price, volatility, that sort of thing. But purely looking at the theta, if your theta is 100, you're going to make $100 a day in time decay. If your theta value is negative, so if you're buying options and your theta is negative 100, all else being equal, you're going to lose $100 each day due to time decay. Okay. So some of you may have seen this chart before. It kind of just indicates that time decay factor that we're talking about. So, a long way out from expiration, 180 days is where we start. Time decay is pretty slow. Then we get close to expiration and time decay really starts to pick up. So, in that last week or 2 weeks of trading, an option is really going to lose a lot of value due to time decay. A lot of people trade weekly options. It's not something that I do. I get asked this a lot. I don't like the risk involved. You have very little margin for error with weekly options. Yes, you get a lot of time decay and you can make good money really, really quickly, but you haven't got much protection against a big move. So if I've got a trade that has 7 days to expiry and a trade that has 45 days to expiry, and then the stock or the index makes a big move, that short-term trade is going to get killed, okay? Whereas the 45-day trade, you might have some losses, but the losses are not going to be nearly as bad, and you've got much more time to be able to, figure out what you want to do. If you want to stay in the trade, if you want to adjust it, things move a lot slower. So I don't trade weekly options. I tend to, even if I've got an iron condor, unless it's right in the middle and there's very little risk of a big move sort of breaching my short strikes, I might keep it open in that case. But if there's any risk at all, I won't take it into the last week. I'll close it out. I'll reopen a new trade for 30 days or 40 days to expiry. I really don't want to have exposure in that last week. Yes, you can make good money. You can make good time decay, but the risk is just too high. And you might have heard of the saying, picking up pennies in front of a steamroller. It's kind of what you're doing here. You're picking up money every week. All of a sudden, bang, you get a big move and you get absolutely wiped out, and you might lose 9 weeks worth of profits, okay? So that's something that I don't really do unless, as I said, if I've got an iron condor and it's into the last week and my strikes are like 10% away, I might hold it into expiry in that case. But even so, if that's the case, those options, those spreads are going to be trading at very little. If they get to within if they get down to about 10 cents, for example, on a typical Russell iron condor, 10 points apart, 10 cents, you've really not got much profit left in the trade. I'll usually just close those out when they get to that level because it's not worth having the risk. You can deploy your capital elsewhere. So really, I try to avoid that last week. Okay, so the last couple of Greeks, gamma is an important Greek, but it's probably not quite as important as some of the other ones. It's a metric which is a sensitivity of the delta to changes in the price of the underlying asset. So gamma measures the change in delta for a $1 change in the underlying. Okay, if that's confusing, don't worry, I can explain this more as we go along. But basically, gamma is your sensitivity to price risk. So if you've got a lot of short gamma and a stock makes a big move, you're in trouble. If you've got long gamma and the stock makes a big move, that's great. That's what you want. Iron condors are short gamma, so you don't want prices to move around a lot. Okay, so hopefully that makes sense. Gamma, and again, we're going to cover this more in session 2, but gamma is highest towards the end of an option's life. So in that last week that I was talking about, they call that gamma week. That's because there's a lot of gamma risk. If the stock makes a big move, you've got a lot of risk of losses if that happens, okay? So, don't worry too much about gamma if you're just starting out, but, other than just maybe be aware that if you have a high gamma exposure, that can be a problem if the stock makes a big move. Rho is the last one. So Rho is the option sensitivity to changes in interest rates, and most traders have very little interest in this measurement. So, the last few years we've been in a really low interest rate environment. Interest rates haven't been moving around all that much, and generally with 30-day or 60-day options, changes in interest rates aren't really going to have a meaningful impact on the price of options. So most options traders don't really worry about Rho. The only time it might become a factor is if you're trading LEAP options, which are sort of long-term options, sort of 1 to 2 years to expiry. You've got this what's called cost of carry. So you've got that option that's got 2 years of life, and a change in interest rate can have an impact on the cost of carry, which can potentially impact the price. So it's going to impact longer-term options more. If you're just trading 30 or 60-day spreads or condors or butterflies, Rho really is going to have absolutely no impact, so you can kind of ignore it if you're a short-term trader. Okay, step 5, which is strategy selection. So, there's literally hundreds of ways to trade options, hundreds of ways to trade the stock market, hundreds of ways to trade options, and over the long haul, I strongly believe income trading provides one of the best opportunities for generating consistent profits. So every trader should master at least sort of 3 or 4 income strategies and select the best one based on their trading style and market outlook. So if you're starting out, 3 or 4 is a good place to start. You don't want to get overwhelmed. As I said, I've got about 6, which I'll cover shortly. But if you can start with 3 or 4, and they might be, iron condors, butterflies, covered calls, something like that. Okay, that could be your 3 that you start with. If you can really master those and develop that routine and that consistency, then you're going to start to see some results. So in terms of strategy selection, these are my 6 core strategies that I use, and I'll cover them briefly today, and then I'm going to go into them in much, much more detail as we go along. So iron condors, probably a lot of you are very similar trading iron condors, so we'll look at those. Butterfly spreads, so that could be standard at the money butterflies, or I tend to use a bearish butterfly, which I'll explain to you guys later, which is a really powerful strategy. Covered calls, or the wheel, as I've got there. Again, I'll cover this shortly. We've only got time to go over this basic intro today. But the wheel is basically a process where you sell a put. You decide on a stock that you want to buy. You sell a put. If the stock goes down, you get assigned. You own 100 shares. Then you sell a covered call on those 100 shares. You also sell another put. If the stock continues to go down, you get assigned again. You've now got 200 shares, and then you start selling 2 covered calls every month until eventually the stock rises back up and gets called away. So that's a really, really powerful strategy. That's something that you can do with sort of the long-term portion of your portfolio. So that's something I sort of advocate, is separating your portfolio into more of a trading capital and an investing capital. So you might have 40% say in your investing account, which is longer term. You can do these covered calls in the wheel on certain, typically you want to be doing it on blue chip stocks that pay a decent dividend, or on sort of index ETFs, so SPY, that sort of thing. If you just want a broad exposure to the market, you could do it on SPY, IWM, the Qs, or you could do it on sectors or country ETF. So I've done the wheel on things like EWZ, which is the Brazilian ETF. Volatility is quite high on that one, so the options premiums are quite juicy, and that can be a really good strategy. So that's one that I do. Diagonal spreads, so that's a really nice strategy. I actually do this one on a weekly basis, so I might do this on a 5 to 10 days to expiry. So the good thing with this one is it doesn't have a huge amount of gamma, so you don't have that same sort of price risk that you do with iron condors if the stock makes a big move. So I'm a bit more comfortable trading that strategy on a shorter term basis, but I will also use it as a monthly trade or a 30 days to expiry sort of trade. So that's a really powerful strategy. You can actually, with that strategy, depending on how the stock moves and the timing, you can make money if the stock goes down or up, potentially. So it's a really, really powerful strategy, which I'll teach you guys. Strangles are the next one. So long strangles and short strangles. Typically I want to be doing long strangles when volatility is really low because you've got that positive vega, you're buying volatility, and short strangles when volatility is high. Now short strangles are a kind of undefined risk strategy, so I really don't recommend it if you're just starting out because the losses can be big if the stock does make a big move. So not something I do regularly, but the way I use strangles a lot is as a bit of a hedge. So if I've got a couple of condors on, I've got a lot of short volatility, a lot of negative vega. What I might do is I might buy some long strangles, which gives me positive vega, and then that helps just hedge my portfolio a little bit. Does that make sense? Okay, so a little bit of a hedge there, you know, and we've had a really low volatility environment recently as well. So, you know, it's made condors and things like that a little bit hard at times because you can't place your strikes very far away from the market. So that's where strangles can come in. You know, when volatility is really, really low, you can buy a strangle. You know, if you go a decent way out in time, I usually go about sort of 6 months out. The time decay doesn't hit you too bad, and you can just leave it open for a little while and hope that the stock or the market makes a big move, and you'll end up making a profit on that long strangle, and that can help offset some potential losses if the condor, if you've got condors open and you get hit by that big move. Okay, so that's how I use strangles. And then the last one there is the iron trapdoor, which is a trade I've developed over the last 4 years or so. It's sort of based on a condor, but it's modified, right? So a lot of people, and again, I've had lots of emails about this over the last few years, a lot of people have been hurt on condors on the call side. So a lot of people, when they think about condors, they're worried about the flash crash, 1987, they're worried about this big drop in the market. But over the last few years, we've had this really strong bull market, and a lot of people have been killed on the upside of their iron condors. So I've developed this trade, and again, I'll cover this later. It's a trade that has sort of reduced risk on the upside and a big profit zone on the downside. So that's performed really, really well in this environment, and I tend to almost prefer that strategy these days to an iron condor. So, you know, just to give you an example, let's say I put on a condor and a trapdoor at the same time. The next day the market makes a 2% move. The condor is going to be in a little bit of trouble. You know, potentially it might need adjusting, or you might need to figure something out, whereas the trapdoor tends to handle that move a little bit better. So doesn't need quite as much adjusting, doesn't need quite as much attention, and it's been a really good trade for me over the last couple of years. So I'll teach you about that one. So covered calls, again, you guys who've traded for a while, it's probably pretty basic for you, but covered calls are a logical place for newbies to start. It's a simple step for those that are familiar with stock ownership to start trading covered calls. The covered call strategy involves owning or buying stock and selling an appropriate number of calls against it. It's a slightly bullish to neutral strategy. It can generate extra income in your account and potentially reduce volatility. The trade-off is that you're giving up some potential gains. And then you can take it to the next step with your covered calls and do the wheel strategy that I talked about. So standard profit diagram there for a covered call. You've still got a little bit of downside risk. You're giving up some of the upside potential, but you've got this extra income potential. Okay, so that's probably pretty obvious for a lot of you guys. Now here's a graph that I like to share when talking about covered calls. And this is a comparison here of basically a buy-right index, so a covered call index, which is in blue, in comparison to the S&P 500. So you can see that over time, covered calls significantly outperform direct stock ownership. So that's a really powerful strategy, especially when you start doing things like the wheel, where you're selling multiple puts and multiple calls. You know, when you take ownership of the stock, you're still collecting those dividends. So in your long-term portion of your portfolio, covered calls and the wheels can be a really powerful strategy, okay? Butterfly spreads, these gain from stocks staying within a very narrow range. Profits can accrue very quickly near expiry, but P&L will move around a lot. So before I was talking about gamma, butterflies, because they've got that tent shape, So butterfly spread and an iron butterfly, or an at-the-money call or at-the-money put butterfly, they're all very similar trades. But that sort of profit tent shape has a really high gamma exposure. So if you get into the last week of a butterfly spread and the stock's right in the middle and it starts to move around a little bit, your P&L is going to swing a lot, okay? Spreads can be wide, so when you're entering the trade, you're trading 3 different legs in one go. So the bid-ask spread can be pretty wide, so you need to be aware of that. So that's you might potentially have a little bit of slippage when you're entering and exiting trades, and also if you have to adjust the trade, you might not necessarily get filled at the midpoint, so that's something to be aware of. Directional butterflies are something I like to use, and they're a cheap way to gain directional exposure on a stock. So, if I think a stock's going up, but I don't necessarily want to buy options that I talked about before, which kind of is very hard to do, I might place a butterfly spread, say 3, 4, 5% in front of the market, okay? And if the market rallies up, I might end up in that tent, okay? And that butterfly, when I put it on, will cost me very little, okay? So that's something that I'll show you guys. And I've also got something where I do a double butterfly. So again, this can be another really good hedge for iron condors. You put a butterfly, let's say 4%, 3 or 4% above and 3 or 4% below the market. If you've got an iron condor on and the stock moves 3 or 4%, that's bad for your condor, but it can potentially be really, really good for the butterfly because you might end up right in the middle of that butterfly. So that's a really good strategy you can use for a hedge as well. So that's a typical butterfly spread strategy. You're buying it. You've got money going out. You're putting in generally a small amount of money, and you've got that high profit potential in the top. With butterfly spreads, very, very unlikely that you're going to make that maximum profit. So basically the top third of that profit graph, profit tent, whatever you want to call it, you can almost cut that off. It's very unrealistic for that to happen, even in the very last day of expiry. And sorry, I know we're covering a lot here, guys. I'm sort of just spilling my thoughts out here. But that last day, even if this particular butterfly, if this stock was trading at 100, the profit might only be $400 or something. You're not going to be right up the top there. It's really only in those last few minutes, and even then, very, very unlikely that you'd make that max profit. So keep that in mind when trading butterflies. This is the strategy I was talking about where I'll use the double butterfly. So this is a graph from Interactive Brokers. So that's the broker that I use. If you guys aren't familiar with it, I do recommend them. They're very, very good. Thinkorswim also is very good. Interactive Brokers, and Thinkorswim as well, actually have really good analytical tools. And this is one of the things that I can do is look at this profit graph. And I can also add a line here that will show me, how the trade will look in a week from now, a week before expiry, whatever date I choose. It'll also show me what it would look like if volatility goes up or down. So it's really, really good. And this is the strategy I was talking about where you place a butterfly, in this example, sort of 2 to 3% above and below the market. If you've got a condor on and the market moves 2-3%, it's going to hurt the condor, but you could potentially do really, really well with this butterfly. You can see this trade didn't cost much, only cost $200 to put the 2 butterflies on. You can see that line at the bottom. That's the maximum that I can lose on this trade. And I've got a really high profit potential. Now again, look, it's 2,300 is the top of each butterfly, but that's not really going to happen. But maybe I could make, if it lands in the middle of one of them, maybe I make $1,000 or something, which is really going to help offset, the potential loss that I might have on the condor. Okay, so sorry, I know we're covering a lot here, and if this is going over your head a little bit, don't worry, I'm going to go over this in much more detail. But another thing you could do is if you have a 30-day condor, sometimes if you get a move in that first week of the trade, it's really annoying because you haven't experienced that time decay and you're in a loss position from day one. So what you could do is you could put on a condor, a 30-day condor, and also put on like a 7-day double butterfly like this, and that'll give you a little bit of protection if there's a big move within that first week. Okay. So that's Interactive Brokers. Thinkorswim is really, really good, probably better than Interactive Brokers. Unfortunately, they don't allow accounts for non-US Well, I think they do allow some countries, but they don't allow Australia. So unfortunately, I can't get one. But Interactive Brokers is really, really good. Has everything I need. If you're using someone like E-Trade, Options House, Scottrade, and any of these other ones, I would recommend switching to Thinkorswim if you can, or Interactive Brokers. I don't receive any commission or affiliate or anything like that from Interactive Brokers, but that's who I use, or Thinkorswim. But I certainly recommend those two if you're not using them. Okay. So iron condors, again, some of you are pretty familiar with these. Some of you have probably been through my 10-part course, so hopefully you've been through that. If you haven't, you can sign up for that. That's no problem. And iron condors are the fundamental option income trade. This trade profits from stocks trading within a well-defined range. They provide a great way to take advantage of spikes in volatility. So you can sell volatility when you get that big spike. You can take advantage of a panic. Iron condors are high probability trades that are easy to manage once you have some experience. Okay, so I'll teach you strategies and rules and things for adjusting these things, and I've got a 10-part iron condor adjustment guide. So that's something that we can look at as well. So typically with iron condors, you might have a really high success rate. You might have 60%, 70%, 80% success rate on these trades. You are going to have losing trades, 10, 20, 30% of the time. And the real key is, as I've mentioned a couple of times today, is avoiding those big losses. That's really crucial with condors, right? So you don't want to have that one trade that wipes out 6 months worth of gains. That's the real key. And you can use some of these hedging strategies that I've talked about to help with that, and also some of the other things I'm going to share with you in later sessions. Okay, so that's our typical payoff diagram. Opposite to the butterfly, not in terms of the shape, but in terms of the fact that we're risking $800 to make only $200. So we've got a low profit amount and a high capital at risk, but we've got a really high probability of success, as we've got a really big range that the stock can stay in. So that's probably pretty basic for a lot of you guys, but that's kind of what we're aiming for, is a high probability of success, lots of winning trades, and when we have a losing trade, we don't want to have that maximum loss. We don't want to have a really big loss. So diagonal spreads are the other one I wanted to talk to you guys about. So they're a cross between a calendar and a credit spread. And they are positive vega. So again, this is kind of crucial if you're looking at hedging strategies. So if you've got a lot of short vega in your portfolio, if you've got a lot of iron condors, maybe you want to add in some positive vega trades. So a diagonal spread would be one of those, double diagonals, things like that, where you're trading both the calls and the puts. Gives you a lot of positive vega, offsets some of that short vega on your condors. So traders want the short option to expire worthless, and leaving the long option that they can either close or hold on to it for potentially bigger gains. Okay, so I'm not going to go into too much detail now because we're getting up on an hour, nearly done, got a couple of slides left, but this is basically what an example of how a diagonal might look. So this is one trade that I put on Russell. You can see this, the index was trading at about 1165. If the stock stayed where it was, I'd make a small amount of profit. Now what you don't see here is on the right hand side the capital at risk. So I think capital at risk was maybe $4,000 or something like that. So $200 in income potential if the stock stays where it is, roughly a 5% return. If the market reverses down, we're not going to lose too much. 200 is the maximum we can lose on the downside. And sometimes you can even enter these trades for a credit. So this line here below the market might actually be up here at around $100 or $200, and I'll teach you how to find those opportunities, right? So this is what I was talking about. I love to trade these on the call side in preference to the put side, and the time I like to use them is when the stock or the index has had a really big run up in price. So think after the US elections, right? We've had this massive run up, 100, 150 points in the Russell. You're thinking maybe the market's going to go a little bit higher, but it's certainly not going to shoot higher. It's either going to drop, stay flat, or maybe go a little bit higher. And that's where this profit zone comes in. So if the market just slowly drifts another 1 or 2% higher, you get up to this 1170, 1180 area, that's perfect for this trade, right? Getting close to expiry. What you don't want to have happen is for the stock to get above, or the Russell to get above sort of 1190, 1200. That's going to be bad for the trade. That's the worst case scenario with these ones. But again, I've got the trading plans and I'll teach you guys exactly how to trade this. But what you're either looking for is a really quick drop in the market. Sometimes you can actually make a little profit if that drops quickly, because remember, you're positive Vega. So if you get a sharp sell-off in the market, implied volatility shoots up, and these diagonal spreads, they're positive Vega, really benefit from that. So you can potentially make money if the stock goes down or goes up. So you want the stock to go down quickly or up slowly is basically what you're looking for. Okay, really, really good strategy, and again, can be used to hedge some of your other trades. All right, long and short strangles. So short strangles are risky because they have unlimited risk, but they can have a place in your portfolio. However, beginners should avoid them. Okay, so your naked options, you've got unlimited risk. Not a good idea to be trading this stuff if you're a beginner. Okay. Long strangles can be a great hedge for your core trades like your iron condors. So, you know, I've mentioned this before. If the market makes a big move, it's going to hurt your iron condors, but the gains that you make on the long strangle can help offset that. Okay. So long strangle should be entered when implied volatility is low and when the underlying has had a period of consolidation. So again, we'll cover a little bit on technical analysis, but one of the main things I look at is Bollinger Bands and the Bollinger Band width. So when the Bollinger Bands are really, really tight, the stock has had an extended period of consolidation. Generally what happens after that is the market has a big move, okay? And similarly, when Bollinger Bands are really wide, the market's been shooting around all over the place. Again, think the Trump election, we went down, we went massively up. Then after that usually comes a calm period, a period of consolidation. So, you know, you get these big wide Bollinger Bands, you want to have short strangles, iron condors, that sort of thing. You get really, really tight Bollinger Bands, you want to have long strangles or trades that are going to profit from a big move, because, you know, things don't stay the same forever. You know, you've got a period of consolidation. What's going to come after that is a period of expansion. You've got a stock that's going through a period of expansion. That's not going to last forever. Eventually the stock will settle down and we'll have a period of contraction. Okay. So I'll teach you all that as well. Advanced trading. So this is the iron trapdoor that I was talking about. This is kind of how the risk graph looks. So it's a modified iron condor. You've got lower risk on the upside. So you can see on the upside, max risk here is 3,500. On the downside is probably about 10 to 20,000, something like that. You've also got this big profit zone on the downside. So the beauty of this trade is you're not going to get killed if the market rallies really sharply, okay, whereas a condor would get killed. If the market drops early in the trade and it drops hard, you're still going to suffer losses. You've got this big profit zone on the downside, but you don't want the stock to get there too quickly. Typically I just trade this on the Russell. And what you want is for the stock to kind of stay flat, maybe go up and down a little bit, and eventually as you get into expiry, you want it to come down just into the start of this little profit zone here, this big area at the back. Okay, so really powerful strategy that I'll teach you guys a little bit more about. The difference with this is, you know, there's always going to be a trade-off. Compared to a condor, we've got a little bit less income potential. You can see there if the stock stays flat. You know, a condor would maybe, of this size, this would be a $20,000 trade. Condor of this size might have $2,000 in income potential, whereas this one's got about, you know, 600. So you're giving up a little bit of income potential, but you've also got lower risk on the upside, and you've got this big profit zone on the downside that you could potentially end up in. Okay, so that's the trapdoor. Talk about that more later. So in the next session, we're going to talk about my two favorite strategies for the market at the moment, those being the weekly diagonal spread and also the bearish butterfly, two strategies that have been working really, really well for me lately. So I'm going to share exactly how I trade those. I'll go through the full trading plan, lots of examples of the weekly diagonal, same with the bearish butterfly, full trading plan with all the entry, exit, adjustment guidelines, and again, lots of examples on that one as well. Alright, so thanks very much guys, hope you enjoyed that, and I'll see you in the next session.